Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. Boy, what an ugly day in the markets today. Buoyed off of yesterday's release of the first quarter GDP report, which showed a surprising drop of 1.4%. That means we're halfway there to an official recession. We'll talk more about that. Interest rates surprisingly held firm today, even with all the selling in the equities market. And what did Elon do to his Tesla stock? We'll visit that as well. In last week's recording, I said that we would start talking about what to look for in a bear market, and we'll do that in this recording as well. Let's take a look at the charts. At the time of this recording, it is late on Friday evening, so the futures market is closed. Thank goodness. Boy, in last weekend's recording, we used the headline bloodbath, and I think that terminology certainly applies to what happened in the markets today. So when you take a look, you can see that we finished on the lows today, and we broke below that all-important 420 level. So we would want to see, all right, what happened with volume? Well, it was above average volume, but it wasn't one of those big spikes. It doesn't feel cathartic enough to me for this to be the end of the selling. I still feel like we need to have a big, massive spike in the VIX with a ton of volume on a down day that's about as ugly as today. Now, this isn't the first time that we closed below 420. Going back to Tuesday night, in Tuesday night's TradeFinder, we were kind of in a similar spot. We closed at 416, closed at 412 today, so not that far different, but also closing on the low and also with just above average volume, but nothing real significant. The difference in Tuesday night, though, is the fact that from where the close was and the 10-day moving average was some decent separation. We were oversold, and it felt like, well, we probably need to have a little bit of a bounce to finish that or complete that oversold condition. And we did on Thursday, yesterday, hitting the 10-day moving average on the high. So now the oversold condition is rectified. And then you look at today, and even though we closed a bit lower than we did Tuesday, look, the high of the day almost touched the 10-day moving average again, meaning that even though we closed lower today than we did Tuesday night, we're not as oversold as we were Tuesday night, which is not boding well for the beginning of next week. And while I'm talking about TradeFinder, we do it every Tuesday night. If you haven't signed up for it, do so. You can sign up in this video, underneath the video, or go to our website at ewotrader.com. We do it Tuesday nights at 9 p.m. Eastern Time. We talk the markets, we look for trading ideas, and we have a live Q&A in the end. It's a lot of fun, so I'd love to have you come along. All right, if we take a look at the weekly chart, last week I promised that we would start talking about bear markets and the potential for us moving into a bear market. The classic definition of a bear market is when you retrace 20%, so you have a 20% correction over at least 2 months. That's the official definition of a bear market, and the average bear market lasts a little over 9 months, about 9.6 months. So when we go back and look at the time frame here in March of 2020, it's seen that we had a significant move to the downside. Now, a lot of people count this as a bear market because we corrected 34%, but that correction only lasted 33 days, so it doesn't quite meet the second criteria. A lot of people add that in, however. Now, another piece is that there's normally over 3 years between bear markets. Now, if we're going into a bear market now, which I think we are, there certainly hasn't been 3 years since what occurred in March and April of 2020. So that's another reason why I don't necessarily count that as an actual bull market. It was, or excuse me, an actual bear market. It was just a vertical move with COVID, and it was just an unusual scenario. So when we look at the markets here, you can see that we haven't even broken that 33% wave 4 correction here yet. And I think that if we go down and hit the 400 level, so let's go back and look at the daily chart on the SPY, and I'll remind you of this big zigzag pattern, and it'll give you a potential target there of just below 400. So back on the weekly chart, if we come down there, we're going to get in that area of a 38.2% wave 4 correction. Perhaps we can hold there. How long will it take? You can see that on the weekly chart, we also have a zigzag underway here. And same scenario there, same target, makes sense. So that gives you an idea of where we would be right around that 38% level, filling that gap at 400 that we've talked about numerous times. and then we'll see how things play out from there. The GDP came in for the first quarter of this year at a drop of 1.4%. That surprised people a bit. So we're halfway to an official recession. So we're going to have a recession, an official one by definition, and an official bear market for 2022. It's certainly looking that way. So at least the first half of the year, not too much fun. But that gives you an idea of where we are in the weekly chart and where we could go on this move to the downside. And then once we hit that, once we hit this 100% level, then we have to look and see what our confirming indicators show in case we have the potential now of moving to 161.8% extension on the zigzag pattern. I'm interested in your comments. Do you think we're going into a bear market? Do you think we could go below 400? Post a comment underneath this video on whether or not you think we're going into a bear market and how low we could go from these levels at this point here. All right, so looking at the 10-year interest rates back to the upside a little bit today. Nothing significant, but I think it's a little bit significant on the fact that with all that money coming out of the equities market today, it didn't necessarily rush into the bond market. Otherwise, rates would have dropped today. But rates just held steady, basically right in that area. We had the pullback where we'd gotten a little overbought, if you will, or rates had gotten a little bit above the 10-day moving average, and now we've corrected that level, and we're teetering right around that 3% level. I think we should go ahead and take a look at the yield curve again. And when you look at the yield curve, you can see that there is a slight steepening of the curve. A lot of people look at the 2s and 10s, so you look at the 2-year at 2.72 and then the 10-year at 2.93. So we're not inverted. There's a slight steepening, as I said, nothing too significant there. So still showing signs of economic weakness out of the bond market. The dollar did correct a bit today. Not concerned about that. I was more concerned with how vertical we went to the upside. We talked about that during TradeFinder as well, with the fact that the dollar had gone so vertically. Bank of Japan helped out on that because they decided they were going to keep their rates lower, so it hurt the yen. So a lot of money came out of the yen and into the dollar. But we were significantly overbought on the dollar yesterday. Look at that separation between the dollar and the 10-day moving average. And then you already know what I'm going to say now. I don't like this vertical move. I'm in favor of a strong dollar, so I'm happy that the dollar is holding in there, but I don't like the fact that it's gone so vertically to the upside, because that means it may come vertically right back down. A little bit of a start to that today. We'll see if there's follow through to the downside. Still overbought on the dollar, at least with the 10-day moving average, but I think that we could possibly come all the way back down towards this area of 100 or 101. Due to the fact that it was so vertical moving to the upside here. So I just don't want to see any sort of negativity with the dollar as far as the dollar's falling and create any sort of concern globally in the dollar. Looking at some of the other markets, and we look at the Dow, you can see that it didn't really break below its support level there at 330, so one of the better looking charts of the markets, the best of the three between the Dow, S&P, and the Qs, but we are in a 5-wave impulse pattern to the downside here as well. Barely stayed with the qualification on the wave 4, so if the Dow breaks below 330, we're probably coming down towards that 310, 315 area on the diamonds. And the Qs, what a mess they were today. If we look at the 10-day moving average here on the Qs, again, look at that. Not really oversold, even though we are a bit below the 10-day moving average, but we touched it on the high. So the separation between the close and the 10-day moving average is a slight oversold, but not that significant with the fact that we actually touched it on the high of the day. And so breaking below 320 pretty significantly. If you've heard any of these videos, you know I've said this numerous times. I feel like the Qs are going to underperform all the rest of the U.S. markets this year. Even if the markets do finish to the upside by the end of the year, I still feel like the Qs will underperform the S&P and the Dow. And so breaking below here, it just looks like only a matter of time before we break down to the 300 level or possibly a bit lower. On the Russell actually showed up on unusual put buying today. So this trading range we've been talking about for 2022 between 190 and 210 has been broken with some follow through there, and with a lot of people buying puts expecting this wave 5 to come down here and hit the 175. So you can see there's 5-wave impulse patterns on all the major markets basically, except for the SPY, and that's in a zigzag corrective pattern to the downside. So they're all moving lower, but the SPY is a 3-wave pattern where the others have the 5-wave impulse patterns to the downside. So some big money feeling like we're not done going to the downside on the IWM. And if you believe the small caps give you an idea of risk on or risk off, there's a lot of people think that it's showing risk off this time frame. Want to show you some other markets, but before that I thought I would show you Tesla because you may have heard that Elon Musk sold a bunch of stock, over $8 billion worth of stock, and he did that on Tuesday as well. And so this big move to the downside here. So this purchase of Twitter is costing him a whole lot more than what he was talking about as far as the price, $40+ billion to buy it, because he's lost some significant wealth here in his Tesla shares. Yeah, I know he got the money for the shares that he sold, but they haven't really rebounded or bounced back yet. It looked like they were going to early today, but again, just touched the 10-day moving average on the high, and that was it. And then we're back down here in the area of where the price found itself when he sold the shares. Now there is support right here in this area. If it can hold here at 880, got a chance to perhaps bounce back to the upside. But if we can't hold there, then we're probably coming down here in this 800 range, and then we'll see what happens once we get to 800. But I thought I'd bring up Tesla and Bitcoin. Bitcoin is trading still below the 40,000 level. Again, we've talked about the fact that the impulse pattern had become disqualified, which was a positive. And all in all, I think it's pretty impressive that Bitcoin hasn't fallen further. I really kind of thought that breaking this 40,000 level, and that if we broke it again today, that we'd be down here at 36,000. But so far, we haven't. I still feel like that's where we're going, breaking below 40,000. Pardon me, because we haven't gotten back above that 40,000 yet. So I feel like 36,000 is an area where we'll try to find support. But if it can jump back above 40,000, then we always have the possibility of holding there. Just with everything that's going on in the markets, I see that as a lesser scenario. Now, if we look at Canada, wow. We talked about this Tuesday night in TradeFinder also, with the fact that we were really oversold. In fact, if I walk it back, Friday, Thursday, Wednesday, there we are, Tuesday. Look how oversold we were in the Canadian market. And I thought with these gaps here, we might go ahead and have a pretty good bounce out of the Canadian market being that oversold. There was some support at 37. So the stair step here, where it's every 4,000 in Bitcoin, it's every point here on the EWC. And look what's happened. 38 has held as resistance now, and we've rectified the oversold condition. We didn't really get much of a bounce, a little bit yesterday with our markets, but hit that 10-day moving average on the high today, closing on the low, and kind of filled this gap, but without more of a significant bounce. So we're still below the 50-day moving average. We still got another gap up above 39 to fill, but how long will it be before we do that? I just thought that we might see a little more strength in the last couple of days out of the Canadian market with that chart showing such an oversold condition on Tuesday, but it just didn't happen. Looking at Australia, check this out. What a nice rebound. Now, Australia was oversold as well, so all we were talking about was everything being oversold on Tuesday night, and then look at this move back to the upside. Now, that's kind of what I thought would occur in the Canadian market, is that we would jump back up like this, back above the 10-day moving average here in Australia. So that's pretty impressive. I mentioned that we were a bit overbought. You can see the separation here from the 10-day moving average when the ASX was trying to break to new all-time highs. So we were up in that area, and we were just a bit overbought. Little bit of consolidation, a bit of a pullback was warranted, not that severe of one, but we're bouncing right back to the upside. And that vertical thing that I talk about, I don't like when things go vertically up because they often come vertically back down. But but it works the same in the opposite direction as well. You can see here the ASX went vertically lower and then boom, quick rebound, V bottom right there. So it looks like we're creating another one. Are we going to make another run at all-time highs? Looks like we could. Getting back above the 10-day moving average today was pretty darn impressive. And I know you got mad at me for leaving out the Nifty last week or just trying to keep these videos from getting too long. But here we are, and it does warrant showing because we still have this symmetrical triangle. It hasn't broken out yet, but look at that nice doji there on the chart. So I think the beginning of next week we get a significant breakout in the Nifty. Now we're in a wave 5 impulse pattern to the downside with a really strong 61.8% wave 4 correction. Elliott would say we're likely to break to the downside here, and perhaps we do. But it's been my experience with these triangles and creating a unique triangle with the triangles is how I kind of made my claim to fame in the world of options. So my experience is that you just allow the fact that you could break either direction out of one of these triangles. Maybe we break lower, but I'm just saying the possibility of breaking higher exists as well. Looking at the DAX, you can imagine with what was going on in the U.S. that we're probably headed lower here. We have closed this gap right here, but when you're looking at foreign markets that trade and overnight from the U.S., you get lots of gaps based on what occurs there. But we are just staying in this 45-degree angle, kind of following the dotted line, which is not what that dotted line is designed for. It doesn't mean the markets are going to follow that. It's just interesting that we are just kind of marching lower to what looks like we're going to have a new wave 5 low. So some of these international markets are looking like we're going to have lower, significantly lower moves. Does that mean the U.S. may go to that 161.8% extension on the SPY zigzag? We'll have to wait and see. Thought I would add in the UK. UK has performed a bit better than the U.S. As you can see here, if we look at the moving averages, touch the 10-day moving average on the high here, and we have some support right in this area here between 31.5 and 32, as you can see on the EWU. Do we come back and test these March lows? Perhaps, but we got to break through this 32 level, which did hold over the past couple of trading days, and then break another little area of support there at 31.5 to test the lows, but performing a bit better than the U.S., at least at this point in time. And last but not least, we always finish with the VIX. Pretty nice move back to the upside in the VIX. So we're back in the high 30s where we were for the end of February and early March. But we spent a lot of time in this area. And I just feel, again, that in order for this to end, because all these days didn't put a bottom in the market, that we just have to have one of those just nasty, ugly days with a big, huge panic spike in the VIX. And that could then put in a potential bottom. When is that going to happen? Who knows? But I'm talking about something like this. It doesn't have to be quite this drastic as we had with COVID in March of 2020, but something along those lines, at least a bit higher than the mid-30s, which again just wasn't enough to put in a significant bottom. We did rally a bit after this into the middle part of March, but obviously we didn't put a bottom in the markets yet, and it doesn't look like they're in so far. So, well, ugly day in the markets today. Still hope you're able to enjoy your weekend. Look forward to talking to you again next week. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.